The Economic Investigator presents an original investigation into power, money, and risk.
I once worked in digital forensics, hunting crimes inside data. Now I treat companies like crime scenes of money. Behavior, fear, and greed matter more than press releases. You are not just watching, you sit on the jury. With AI as my partner, I rebuild these cases visually. Tonight's case file: a fallen crypto giant and its broken empire.
FTX rose fast, a crypto empire built in months. At its peak, investors valued FTX above many banks. He became the wonder kid public face of crypto.
He promised safety, speed, innovation, and something called effective altruism. Yet balance sheets hid a very different story underneath.
Customer funds reportedly flowed into a sister fund's risky bets. If true, the lines between exchange and hedge fund vanished.
1 week in 2022, confidence cracked almost overnight.
Withdrawals surged. Suddenly, there was not enough cash.
Within days, FTX collapsed into bankruptcy. Deposits trapped and frozen.
So where did the money really go? And why?
This investigation follows the trail from marketing to missing funds.
To begin, we must separate the story from the evidence. Carefully.
We follow FTX from dream to design.
FTX presented itself simply: a safe crypto exchange.
Customers deposited coins. FTX promised liquidity and professional risk management.
Bull market euphoria pushed volumes, valuations, and confidence skyward.
On paper, the business seemed wonderfully boring. Trading fees.
He appeared in shorts, messy hair, talking effective altruism.
Media loved the contrast. Billionaire founder who looked careless.
Conference stages, podcasts, interviews amplified his accessible genius image.
Venture capital funds lined up, desperate not to miss.
They invested billions, sometimes after extremely shallow due diligence.
FTX logos covered stadiums, jerseys, and primetime sports broadcasts.
Branding whispered stability. Officials shared panels with Sam comfortably.
Behind the exchange stood Alameda, FTX's closely linked trading firm.
Officially, Apex was separate. In practice, lines blurred.
FTX also created FTT, a token representing future hopes.
That token became collateral on balance sheets and loans.
Using your own chip as safety net is dangerous.
Internal systems allegedly let Alameda borrow against customer margin.
Reports later suggested special privileges, like bigger hidden credit.
While crypto prices rose, nobody questioned the structure loudly.
Profits and sponsorships distracted everyone from basic exchange questions.
But risk does not disappear. It just hides temporarily.
When the market turned, those hidden choices resurfaced violently.
the story began to unravel in public view.
When the bull market died, easy money vanished with it.
A leaked Alameda balance sheet showed massive exposure to FTT.
FTT looked valuable on paper, but real buyers were shallow.
Binance announced plans to sell FTT. Markets smelled blood immediately.
FTX could not meet withdrawals. The liquidity well ran dry.
Public messages claimed assets were fine. Hours later, they weren't.
Estimates suggested a multi-billion-dollar hole where deposits should be.
Within days, FTX and Alameda both filed for bankruptcy protection.
Ask yourself, if deposits disappeared, into which pockets did they flow?
FTX had almost no traditional governance, no serious independent oversight.
They leaned on their own token as collateral, circular, and fragile.
If customer assets backed Alameda bets, risk multiplied silently.
Why did sophisticated investors miss this? Fear of missing out.
They believed the narrative of genius more than the boring numbers.
How many times have you trusted a story more than data?
Would you still deposit if you saw the full risk plumbing?
Weak governance, opaque transfers, and concentration together invite disaster.
Behind headlines are people. Savings frozen, trust shattered, years erased.
The Economic Investigator. The FTX file is closed. Numbers may change, but the market never lies.